Nifty and broader markets wrap up the week under pressure, fail to edge into the positive territory. All the sectors barring media and realty end the week in negative territory. Strong Q1 earnings offer same support.
Nifty earnings in Q1 show a divergent performance. Consumer-facing businesses lead the charge, with durables delivering the strongest profit growth, while telecom and financial services also remain resilient. On the weaker side, FMCG and healthcare see profit decline.
WPI inflation eases marginally for July, comes in at 9.78%. Food and fuel prices also see downward movement. Manufacturing inflation rises as tensions in West Asia remain dominant.
Tata Sons begins its search for N. Chandrasekharan's successor. Noel Tata may chair a selection panel. Darius Khambata, Bhaskar Bhatt and Harish Manwani are also being considered for that panel.
Government prepares plans to become Atmanirbhar in urea production. Fertilizer Ministry holds a meeting with stakeholders to work on strategy to end urea imports over the next 2 years.
President Draupadi Murmu addresses the nation on the eve of India's 80th Independence Day. She says the country's economy is advancing as the fastest growing major economy and adds that India is moving ahead towards building a Viksit Bharat by 2047.
Welcome to India Tonight. I'm Shubhani Ghara, joining you guys from Mumbai, and joining us from Chennai is my colleague Jude Sanit. And Jude, the Nifty 50's Q1 earnings season has delivered a mixed but largely positive picture. Now, with most, in fact, beating estimates, consumer services, oil and gas, capital goods and consumer durables led revenue growth. At the other end, FMCG, healthcare and construction remained weaker. Ashisha takes us through the trend.
Well, yes, all 50 Nifty companies have now reported their numbers for the first quarter of FY27. 21 companies have reported better than expected set of numbers, 10 below, 14 in line, and 5 companies have reported mixed set of numbers for the first quarter of FY27. Let's take a look at how revenue growth looked like on a year-on-year and on a sequential basis. Revenue growth on a sequential basis was largely flat, but 17% is what we've seen on a year-on-year basis. EBITDA growth of 4.2% sequentially and about 16% on a year-on-year basis. PAT, in fact, on a sequential basis has declined, but we have seen a 8% growth on the bottom line as far as year-on-year basis comparison is concerned. Let's also talk about margins. Now, in the first quarter of FY27, they've come in at about 18.3% versus 18.5% same time last year and 17.5% in the previous quarter. So we have not seen any major deviation when it comes to margins, both on a sequential and on a year-on-year basis. Let's also put the spotlight on numbers other than oil and gas. We have excluded Reliance Industries and ONGC. Those are the two oil and gas related companies in the Nifty 50 basket. And barring those, revenue growth of 14%, EBITDA growth of 13% and PAT growth of 8% is what we have seen on a year-on-year basis. Now let's put the spotlight on top 5 sectors where we have seen maximum revenue growth in the quarter gone by. We have capital goods, auto and auto ancillary and consumer durables, consumer services at the top of that list. Consumer services revenue growth of about 117%, followed by oil and gas, capital goods, consumer durables and services with revenue growth anywhere between 19 to 29% on a year-on-year basis. These are the top 5 sectors which have reported maximum revenue growth on a year-on-year basis in the quarter gone by. Let's also talk about the other end of the pyramid. Top 5 sectors we have seen least least revenue growth in. FMCG clearly is at the top of that list. Very tepid revenue growth, largely flat as we speak. Construction at about 6.7%, power at 7%, healthcare and financial services in the range of 7 to 9%. So these are the top 5 sectors with least revenue growth on a year-on-year basis. Let's put the spotlight on operating profit metric then, and let's talk about EBITDA growth. Consumer services EBITDA growth was very strong at 79%, consumer durables at 45%, metals and mining again was very strong at 26%, oil and gas and construction after those in that list with about 25% EBITDA growth. On the other end of the spectrum, top 5 sectors with EBITDA degrowth. Healthcare, in fact, has reported an EBITDA decline of about 10% YOY, services about 8%. FMCG revenue growth was flat, and we have seen EBITDA decline of about 8%. Construction and auto components have also reported very tepid to lower EBITDA growth in the quarter gone by. Let's talk about profitability. Top 5 sectors: consumer durables, consumer services. We have construction and financial services with PAT growth anywhere between 20 to 45%. And on the other end of the pyramid, some of those sectors which have reported very tepid revenue and EBITDA growth have also reported lower profitability in the quarter gone by. So all in all, numbers were largely in line to better than what the street was working with. FMCG is at the lower end of the pyramid, but on the flip side, capital goods, auto and auto ancillary, consumer durables and consumer services, these are a couple of sectors which have reported relatively better performance in the first quarter of FY27.
Well, thanks, Ashesha, for that comprehensive breakdown on just how the quarter was with regard to the earnings season itself. And moving on to discuss a little bit more about what that quarter was like and how earnings fared, we're joined by a panel of experts. Manish Sonthalia is Director and CIO at Emkay Investment Managers. Mayuresh Joshi, Head Equity at Marketsmithindia, also joins us on the bulletin today. Thank you very much, gentlemen, for joining us. Mayuresh, let me start with you. You heard Ashesha there. It's been a largely mixed bag in many ways, but if I look at the numbers, 21 earnings were in fact above expectations, and in fact 14 were largely in line. Now, granted the fact that profitability was slightly under pressure, given that 35 out of 50 companies were largely above or in line with expectations, you'd reckon it wasn't too bad of an earnings season, Mayuresh.
Evening, Joe. No, it was not. And therefore, I think the expectations going into Q1 were largely expected to be very muted. With the West Asian crisis at a full-blown escalation level, the expectations largely were for a muted set across sectors and sub-sectors as we speak. And therefore, I think that the numbers that India Inc. has delivered, specifically when it comes to the index companies, have been pretty resilient so far. But the bigger picture, Joe, has been the broader markets. So if you probably take a construct in terms of how the broader markets have probably performed for the mid caps and the small caps, the mid caps, on an average, the profitability growth has been in excess of 25%, and for small caps, in excess of 32%. So I think that has been an outlier as far as the earnings season is concerned. And therefore, if you just put it in a nutshell, I think Nifty companies, a large part of that universe, as Ashesha put it, largely has been very, very resilient. But the broader markets is where I think the earnings output has come from.
Right. Let's go over to the other panelist, Mr. Manish. What is your view on the market, if you can throw in some light? And with 50 on 50 of Nifty companies having reported their Q1 FY27 results, how do you assess, the overall earnings picture?
So earnings this quarter is definitely better than estimates. And till the company just reported numbers till yesterday, and I'm talking about the NSE listed companies, and we compare these numbers to the last 8 quarters going back to Q2 FY24-25. Last previous 7 quarters, the EPS growth on NSE listed companies, median EPS growth was 5%. This quarter, the median EPS growth of NSE listed companies is closer to around 22%. Profit growth is around 25%. So it's a clear demarcation away from the previous trends. And this in spite of the fact that there are a lot of macro challenges. One positive thing which we can read into what we are seeing currently in spite of the macro challenges is that China's currency has appreciated by 22 to 25%. So manufacturing in India is definitely getting a lift. And that is basically what I'm seeing at the ground level, speaking to a lot of companies. Nobody is very bearish in spite of the fact that we have seen a lot of problems on the macro side. Things are unfolding, but it looks like that this trend is likely to continue. So from that point of view, have the markets priced in all the bullishness? I don't think so. And I think there is a limited downside. Maybe 22,000 could get retested again, but there's a lot of upside. Maybe 28, 29,000. Even that is doable. So from that point of view, I think positives outweigh the negatives. The Middle East crisis is only one thorn, which if it goes away, then there would be an all-round, very bullish sentiment that could come through.
Right, and before we go back to Mayuresh, let me just ask you, Manish, do you think the worst of the macro turmoil is largely behind us? I mean, in particular, has the impact of the West Asia tension and elevated crude prices largely been priced in as far as these earnings are concerned?
I think $90 is the cutoff. Below $90 on crude, we are good, and things are not going to be that damaging for India macros. But if crude sustains above 90, and this is on the back of continuing turmoil in the Middle East, then that's not going to be that positive for India. It's going to be negative. Because not only are we dealing with higher levels of crude beyond 90, we're also dealing with currency. So currency, if it, let's say beyond 30th of September, if we see 70, 80, 90 billion dollars of FCNRB, then we are probably better off than if we are, let's say, after 30th of September, if we get 50, 60 and still the crude starts to move on the higher side. That would be bringing in imported inflation, which is going to be negative for corporate India also, and India macros in specific. But I think to say that we are completely out of the woods, I mean, it's anybody's guess. We can't say that because Middle East is still raging and there's no final settlement that's around the corner. And if supply chain gets choked, then crude can flare up every now and then. And the amount of bullishness lesser at 90 will be far lesser at more than $90. And today we are at 88, 89. So we are okay. But if this number moves towards 100, there'll be negativity that would be coming through.
Right, so we are not completely out of woods and the West Asia crisis still continues. Mayuresh, help us understand, are the oil marketing companies, have they become uninvestable at this point in time? And sectorally also, away from oil marketing companies, AI is also becoming like a big question mark for the Indian tech.
Good evening, Shivani. I think two questions that you asked. One, I think for oil marketing companies, there are too many variables to comprehend with. And therefore, I think the base case scenario stays how crude prices are probably expected to move. On top of that, with the volatility that you probably see in crude prices, the cracks or the spreads that happen in terms of the downstream product pricing is extremely volatile. Third, I think they need to manage their inventory quite well. And therefore, I think in a very volatile situation, you probably see quarters where either there will be inventory gains or losses that probably keep on happening. And let's not forget that the last and the most important aspect in terms of the marketing margins, how much can be passed through if the bill keeps on going higher and higher. And therefore, I think it's a little bit difficult to comprehend how to put these variables together in an extremely volatile environment. And therefore, OMCs become a very, very tricky investable area. On the AI trade that you ask, I think the expectations in terms of the capex that has been put forth by hyperscalers and product companies across the globe, in terms of not just the capex outlay that has probably happened, but in terms of the traction that is expected over the next few years, both in terms of development and deployment of these models that are getting created, disrupting the entire old outsourcing model that our IT companies are probably adhering to. And at the same time, I've been expected to probably have a significant say in terms of how workforce adjustments need to probably take place in terms of the learning curve for all this. Again, I think if you probably peg how AI companies across the globe are probably being valued at this juncture, even with the capex, even with the revenue, and even with the stock price jump up, just as an example, stocks like SK Hynix, as an example, South Korean markets are still trading in middle PE, which is still comparatively cheap compared to what the entire IT sector across the globe is doing. Therefore, I think the threat is imminent and the threat is real.
Absolutely. No, Mayuresh, I also want to focus for just a bit, on that earnings report card. And there's one sector, in fact, that's making for very interesting reading, and that's the consumer-facing sectors. In fact, I'm looking at, the summary right here. Consumer durables, largely as far as Q1 is concerned, led Q1 growth. Consumer services led EBITDA numbers this quarter. But fast-moving consumer durables actually remained the big laggard as far as the last 3 months, the first 3 months of FY27 are concerned. How do you make sense of this, really? What's happening in the consumer space that investors perhaps might need to keep an eye on?
So I think both for discretionary and durable, I think the large part in terms of volume growth actually was very robust, and which was very, very surprising, because the expectation largely was that it might be a little bit more curtailed when it comes to the volume part as far as both discretionary and durables are concerned. However, I think it has been a very, very strong show when it comes not just to the top line, but the EBITDA performance for both these sectors put together, and the profitable growth was in fact even more robust as we see it. And therefore, I think now the expectations that are now getting built in is specifically on the geopolitical front. I think if this lingers longer than one really expects, does this create some sort of a dent in terms of the inflationary pressures that are probably getting created across the globe? If that situation plays out, I think the demand-led growth, which has led both these sectors very, very strongly, that does taper a tad bit in terms of the demand-led growth and the volumes thereof as we speak. And the third element in terms of expectations of how consumer discretionary spending is expected to play out, if El Nino probably plays out, and if monsoons are not close to long period averages, there will be some element of cut that probably happens in terms of spending when it specifically comes to the durable or the discretionary front. And therefore, variables need to be monitored. For the FMCG sector as a whole, my own sense is that commentaries were relatively resilient as we speak. But a lot of commentaries are pointing out to the same variables that I'm speaking about in terms of how demand will probably play out. And input cost inflation has definitely started creeping higher. Therefore, I think these variables definitely need to be watched for consumer spaces.
Manish, let's get over to you. We spoke about how the worst is not still behind us, but help us understand which sectors are you the most bullish on, and where would you still remain cautious going forward?
So cautious is basically the oil and gas space. A lot of moving parts out here. Full pricing of the raw material, which is basically essentially crude, is not happening. Even this quarter, we have seen massive losses come through for the oil and gas sector as a whole, a big drag on the overall earnings. So contrary to that, I think even for the full quarterly results, we have seen some margin dent. So I think the sectors which are quite positive is the high-tech sector, which is your aerospace, defense, semiconductor, medical, which is the entire healthcare space, looks good. The energy transition value chain from solar, wind, hydro, nuclear, battery energy, electric vehicle, these are all very good. Consumption, including autos, and autos is firing on all cylinders thanks to the continuation of bullishness because of the cut in GST rates from 28 to 18 is trickling down in volumes, and also the auto ancillary is doing well. So consumption is a dark horse. And I think logistics also is coming off a low base, and outlook on the logistics space also looks quite good from the next 2 to 3 year point of view.
Right. And Manish, you mentioned high-tech sectors, but what is your view on the good old Indian IT sector in particular, Manish? After the spate of recent underperformances, do you see an attractive opportunity here, and has your stance turned bullish?
No, so it's a dead cat bounce, to say the least. It could trade up another 10 to 20%, but to have perennial bullishness come through, I think it has to see through earnings growth. And earnings growth, even now, the visibility factor is around 10% sort of a rupee earnings growth. So valuations are very good in terms of dividend yield and free cash flow yields, and the valuations of 1450 prices to earnings multiple. I think there's ample margin of safety. But is it a very long-term story in terms of bullishness just now? I would refrain from that. But yes, it is a definite contraplay. The stocks have fallen so much that there is a big possibility that it could rally even from here. That's more of a tactical bet as opposed to a structural bet at this given point in time.
We come to auto. Now, this entire auto demand is currently driven by the urban markets. And of course, the SUVs have been like a big shining star for, the passenger vehicles arms of the auto companies. Now, what if, like this premiumization trend in the auto that, this industry is going through, it flattens out towards the next half of the year? What happens to auto, because nobody somehow seems to be buying the mass market cars anymore, and everyone is going for the premium variant is what, we see on paper.
No, so to that extent, I think what really transpires is that, as Manish pointed out, post the GST cut, I think the kind of demand dynamics that played out for the sector as a whole were pretty strong. Having said that, I think the kind of new models that are expected to still get launched, and you're absolutely right in terms of the entire premiumization trend that is happening for the industry as a whole. I think that is where I think the crux probably lies. Innovations, the expectations in terms of more launches that are probably happening across the entire ecosystem is probably keeping auto companies in favor. However, I think as we head into the second half, the base for all these companies are going to be relatively higher, because the second half is exactly where I think the GST cuts and the effect started taking place last year. And therefore, now on a year-on-year comparison, as we head into the second half, to maintain that run rate on a year-on-year basis is something to be watched out for. And therefore, our take at Marketsmithindia India, very clearly, is that auto ancillaries seem to be a tad bit better placed for two reasons. One, I think with the new launches that are expected to take place on the EV front, a lot of the auto ancillary companies have actually veered themselves towards the entire EV power train ecosystem model and creating those agnostic products as well. And therefore, I think the content per car or content per vehicle, whether it's two-wheelers, four-wheelers, commercial vehicles, are going to move multifold over the next few quarters and years. And that is where the incremental benefit is going to happen. They're increasing capacities, improving their product mix, servicing the replacement market. The margins are expected to reach higher because the leverage on most auto ancillary balance sheets are still very, very minimal. So I think to put it very simply, auto ancillaries probably seem to be a tad bit better place compared to.
Manish, I'm reserving my last question as perhaps the most, as the million-dollar question, the one that's on everyone's mind right now. How soon do you expect FIIs to make a meaningful comeback into India? And how do you view India's current valuations versus the rest of the world, Manish?
Very difficult to take a call on what FIIs will do or not do. But what I can say is that they were worried about two things. One was expensiveness of Indian markets compared to other emerging markets. This number was, India was trading at 100% premium to other emerging markets not so long ago. So that number today is, the premium is got whittled down to just 25%. So India is just 25% more expensive than other emerging markets. Currency, which was the major problem from the FII point of view, have stopped falling for the time being, thanks to timely action by RBI on the FCNRB. We have got some decent flows into India and more is likely to come. So if you are looking at the earnings growth, it is in stellar shape and form. If you're looking at the currency, if it is not falling and India's premium valuations have come down significantly vis-a-vis other major markets, there is a definite case that the allocations of FIs should increase in India vis-a-vis what we have seen from their front in the last 2.5 years. So we don't know what they are going to do or not do and how they think. But I think the macro factors, leaving aside the macro factors impacting India at the micro level, in terms of corporate India's balance sheet and profit and loss account and growth, significant, and valuations are not that prohibitively expensive. FY27 benchmark Nifty 50 would be at around 20 times, which is not very expensive.
Thank you so much, Manish and Mayuresh, for joining us on ET Now and giving your inputs and insights on the entire earnings season. Well, on that note, it is time for us to slip into a very short break. You don't go anywhere. We'll be right back.